Welcome. Today we're going to talk about Fatca, which is an acronym that stands for the Foreign Account Tax Compliance Act. Before we get started, let me just talk briefly about Montage Services. It's a professional service firm that is global and has offices in San Francisco, Houston, London, Toronto, and Berlin. What is Fatca and why is it important? Fatca was put in place in 2010 when there was a number of U.S. taxpayers who had not reported their income, and they were all members of Union Bank of Switzerland. That, during the financial crisis, caused Congress to enact a provision that would in essence flush out all these U.S. taxpayers who had not reported their income in prior periods. The legislation that they came up with is known as Fatca. What's interesting about this legislation is it applies to foreign companies, non-U.S. companies. So in that vein, it's not applying to U.S. organizations, it's our government applying our law to foreign countries and to foreign entities. In particular, they break it down into two areas. One is foreign financial institutions, and secondly is non-foreign financial entities. For foreign financial institutions, we're talking about banks, custodial institutions, and life insurance companies. The non-foreign financial institutions would be those that are classified as investment entities or certain holding companies in large group structures. For the foreign financial institutions, what they're looking to do is get those financial institutions, such as banks, to report who are their U.S. account holders. For the non-foreign financial institutions, what they're trying to do is get them to report who are their U.S. shareholders. How do they do this? Well, they're going to enforce this through a punitive withholding tax regime, which is to say that any foreign entity that receives certain payments from the United States will be withheld at 30%. And that will start July 1st, 2014. This withholding will be applicable to U.S. source payments of interest, dividends, rents, royalties, and other annuity-like contracts. The Fatca requirements state that if a foreign entity registers with their U.S. government and receives a GIN, which is another acronym for an ID number, that foreign entity can provide the payor of the U.S. source income that information, this GIN number, along with a W-8BENE form, and that will relieve them of the withholding tax. As many of you know, there is withholding normally on interest, but that is offset with tax treaties. This will not be offset with tax treaties. Because the U.S. government is enforcing its law on foreign entities, one has brought up the question of how far can the U.S. government go? And so the U.S. government has entered into agreements with other foreign countries, and these intergovernmental agreements do not limit this withholding, but what it does is say that if you're going to report the information on these U.S. account holders or U.S. shareholders, you do not need to provide it to the U.S. government, you have to provide it to the other country's government. So, for instance, if we have an intergovernmental agreement with Germany, the German bank would provide that information to the German government and not to the U.S. government. Countries where we have entered into these agreements with are such as Germany, the UK, the Cayman Islands, but we have not entered into these agreements with India, China, or Hong Kong. So there's some key dates to be considered. First is by April 25th, 2014, the foreign entities are supposed to register on the IRS website and obtain that taxpayer ID number that I referred to in order to alleviate the withholding that kicks in on July 1st, 2014. Then, in March of next year, 2015, is when the reporting is required on the U.S. account holders or U.S. shareholders. Montage can help organizations in determining whether or not these rules apply to their organization. We can also register the companies online with the IRS government, which is a very lengthy process. And we have the capability of looking at the systems that are at the organization to finally report what is required back to either the U.S. government or to the foreign government. So with that, I'll open it up to questions. Do we have any questions?
I do. So for a foreign company that is a resident of a country that has an income tax treaty with the United States, does the 30% withholding rate still apply under FATCA?
So the question was asked, if the U.S. has a tax treaty with another country that reduces the withholding tax, will that trump the FATCA withholding at 30%, or does the 30% apply regardless of a tax treaty? And it is the latter. So the 30% withholding overrides the treaty rate, and the taxpayer can try to reclaim it back as long as they've proven out that they've adhered to the rules as required under FATCA. Any other questions?
I have one. If the U.S. has an intergovernmental agreement with another country and entities in that country report the U.S. account holder information to their local government, does their local government then share that information with the U.S., or how does that work?
The question was asked whether or not, with an intergovernmental agreement, if the information is provided, for instance, to the German tax authorities, does the IRS ever get that information? And the answer is they would if they request it. So the request is so far been based on whether or not they do not believe they have adhered to the requirements in reporting the information back to the tax authorities. In other words, the individual bank account holders or the individual shareholders. If the U.S. government believes there is a criminal situation, they will first go to that government and request the release of that information. What that does is allow for that other government to say, well, we can release some of the information, but maybe not all of it. Okay, that is all we have on FATCA, and we hope you listen to our other series of informative discussions.